€10,000 to invest. It's not a trick question. We're just trying to get a gauge of what people's kind of views are out there. Again, just to make it a little bit more lighthearted. So, look, we're coming to 1 o'clock. So, what I'm going to do is I'm going to get started. As I said, I do appreciate your time, and we are recording this webinar if anyone needs to or wants to listen back to it. And also, we're going to be sharing the slides with you. For those of you that don't know me, my name is Nick Shell-Lambis, and I'm the Managing Director of Alpha Wealth. I run a financial services company primarily based in Cork, and there's currently 6 of us working as financial advisors. We do have a small presence in Dublin. I suppose one of the benefits of COVID has been that it's made us more national. We have a wider reach now than we had previously. We tend to do a lot of Zooms. We are offering 30-minute free complimentary consultations with clients, and we provide advice in a variety of areas. And today's focus is going to be on really helping business owners and senior managers create wealth for themselves, really, and to get more of their money working for them. And I'm going to go through some examples with you this afternoon. My colleague, David Looney, who's the other financial advisor, and I'm assisted by Rebecca O'Callaghan, Tracy Mooney, Keenan, and Rachel, who are all expert in giving advice, as I say. So I'm going to just talk about a business, and whether you're a senior manager working for a company or whether you are a business owner. One of the things I constantly talk to clients about is how can you reward yourself? How can you get money out of the company, either by way of salary or other forms of remuneration? And as I'm sure you're aware, once you hit a certain point, which tends to be 38,000 a year, you pay tax at a 52% rate, which is not ideal. And really the mainstay of helping individuals from a financial planning perspective is to say, well, what else can you do? What other opportunities are out there? Whether it's, using other vehicles and so on. So this slide I've just thrown up there shows like salary, dividends, bonuses are all subject to tax in the same way. Once you add USC and PRSI onto the high rate of tax, it is quite excruciating. Now, with regards to creating wealth for business owners and senior managers, there's really 2 things I'd like to leave with you today, and these would be the takeaways I'd like you to take from the session today. The first of which is that you can benefit from getting tax back from the government. There's a tax scheme called the Employment Investment Incentive Scheme, and it allows you to offset the tax that you pay at the top rate, not only against earned income, i.e. your salary, but also rental income. I come across clients who do have a second property that they do receive rents on, and they are paying a lot of tax on the rental income. And this is an opportunity for them to reduce that, but alongside their tax that they pay on their salaries. So for example, for any individual out there that's earning more than say 50,000 a year, they are typically paying more than 10,000 a year in tax. The one thing I'd say to you is that if you have some money sitting in the bank account, and the minimum of which is 5,000 euros, you can benefit from getting 2,000 euros back from the taxman next year, with the 5,000 plus another 1,000 euros at the end of a 4-year period. And a lot of people are not aware of that this type of scheme exists, and our job in Alpha Wealth is to educate and help people with this. Okay, and I'll talk about that briefly in a bit more detail in a moment. I'm going to talk then secondly about pensions. People have a little bit of a misguided view about pension schemes, and I really think that pensions are underutilized in Ireland. And the reason I'm saying this is that people who have a pension scheme typically tend to pay in amounts that match what their employer's doing, or they might do it because they think it might be a good idea, but they're not entirely sure why. And really the focus today is about saying to people, look, do you know what's in your pension scheme? Because you should, in my opinion. And secondly, do you have an idea or a target in mind as to what your pension's likely to be worth at the age of which you want to draw this money down at? And I specifically not said the word retire, because I think retire is a bit of a misnomer. So for example, I'm 47. I have a goal that I'd like to be able at age 60 to be able to do something different if I choose to in a financial perspective, or not necessarily work the same hours that I am currently. So I have a plan where I have a roadmap for the next 13 years as to get to the point that I want to. And it's not just about a pension, but it's one of the, I suppose, pieces of the jigsaw that I'm trying to piece together for my financial well-being. I've noted a couple of other things there, and these are kind of small takeaways. One of them is that if you are a manager in a company and you are fortunate enough to receive shares, one of the things that I tell people all the time is you should look to sell these shares every year. I don't care what company you work for, and whatever strength of the company you tell me and how you think the share price is going to go. There is one big advantage to selling shares annually that you may receive, which is that you get an annual tax break. So you should utilize that. And again, I can help you and explain to you exactly how it operates and why that makes sense. Specifically for business owners, for those of you that own your own business, one of the things I would suggest that you may consider doing, if you're not already aware, is that you should look to hire your children. I know it may sound a bit left field, but if you have a child who's 14 years of age or older, it is totally allowable for you to employ them, get them to do some menial tasks, a bit of admin during the summer, and you can pay them up to 8,000 a year tax-free. A lot of business owners do that. I would suggest that it would make a lot of sense for a lot of business owners to consider this and speak to your accountant if you've not already taken advantage of that. So I just want to drill down a little bit on the first of the tax back schemes that I mentioned, which is this EIIS scheme as it's known. A couple of examples thrown up on the screen here. We've done some work with a few companies based in Ireland. This is essentially an individual. So I'm going to use myself as an example where if I have 5,000 euros, or if I can build up 5,000 euros, if not this year, the next year or the year after, and I'm prepared to invest it for 4 years. As I said earlier, the government will give you back 2,000 euros, 40% of that investment amount in the following year of tax that you've suffered this year, and you will receive back a figure of around 6,000 in 4 years' time. I'm not going to go into massive detail with you today, but just to mention that we are working with a few companies. I've listed them on the screen, one of which is a whiskey company based in Cork, run by the likes of Colin Ross and Ernest Cantillon, who own bars here in Cork. There is an IT company called MX, and there is a health food company called Dairy Concepts, who produce a milk bar called Fruchi that you may have seen sold in some of the super values. And we're going to be doing webinars with these companies over the next few weeks. There is one next Friday, the 23rd, followed by one next month on the 12th of May, which is the whiskey company that I mentioned called Kinsale Spirit. And again, that's not for the crux of today, but I'd like to be able to talk to you in more detail about that if and when it suits. With regards to a company owner getting money out of their business, or indeed, how a senior manager can benefit more from their employment. I said earlier, but pension schemes make so much sense. Like I run a company, I get to my year end, which is 31st December. I don't particularly want to pay too much in tax. How can I reduce that? Well, if I pay myself an extra amount in salary, the tax man's going to hit me for 11% employer's PRSI, so it costs me 11,100 euros, and the tax man's going to hit me for 52% on that payment. So I'll end up with less than 5 grand on the 10,000, which has cost the company 11. One of the alternatives to that is that I write a check to my pension fund. The employer's PRSI does not kick in, so I don't have to pay the 1,100 euros. And also that the 10,000 euros gets invested into my pension fund. And to boot, the pension fund grows tax-free, so the tax man's not going to touch the money whilst the money is growing, and I can access that money from age 50 onwards. The key thing to know is that some of you may already have pension schemes. It's really important that you are not being overcharged in fees. And I say to clients all the time that you should really keep a very close eye on the fees that you pay, because you can lose thousands and thousands of euros by overcharging. And this has been rife in my experience as a financial advisor for the last 20 plus years. And obviously we're seeing more and more people come out saying, you know, they are now aware of the fees that they're suffering. I have some clients who kind of talk negatively about pensions, and with the greatest respect, I think that they have been poorly advised in the past, because I have been managing clients' pension funds for the last 20 years, and I've never had a client feel in any way put out by the fact that they have made significant amounts of return on their pension funds, and I believe that they've been appropriately invested. The one thing to, I suppose, hammer in is that if you were kind of wondering, well, okay, Nick, what should I be aiming for as a pension fund? Well, the maximum that you can aim for is 2.15 million. And that figure may seem like pie in the sky, and it's not really. You know, I have many clients that are looking to achieve that. And to put it in context, if you're in your mid 40s and if you haven't even started a pension fund, if you're in a position where you can put 5,000 a month, or between yourself and your employer, you can put 5,000 a month in, you'll get to that number. If you're in your early 40s and say you're looking to draw this benefit down at 65, then that figure reduces down to 3,500 a month. Or you can make it up by lump sums. I have many business owners that are writing six-figure checks to their pension funds, not because they're particularly wealthy. They've just built up some cash in their company that they have no other use for, and they don't want to pay too much in tax. So it makes complete sense. And the one thing I would like to reiterate is that the sooner you do it, the more time you give yourself. And Einstein said, you know, about this, you know, compounding effect being such a powerful force. It really is. You know, don't delay on pensions is the key message. And the other thing is that if you've been in a position whereby, let's say, you've not spent as much money because of COVID restrictions and not being able to spend money on foreign holidays, now is the time to think about your pension scheme. With regards to the opportunity, if you're a business owner, and some of the angles I want to mention today are, you can put up to 25% of your salary if you're in your 40s in a personal environment, and that has nothing to do with your employer. A lot of people misunderstand that if your employer is paying in, say, 5% of your salary, it somehow limits what you can do. Or if your employer is going to pay you a bonus of, say, 5 grand or 10 grand, that impacts upon what you can put into your pension. It absolutely doesn't. If I was working for a company today and if I was getting a bonus from that company, I wouldn't want to get it in salary. I really wouldn't, because I wouldn't want to pay 52% tax. I'd say to my employer, can you please put into my pension scheme? And some of you are in a position where you can probably force that. And that's an angle that I would suggest that you might consider. One of the other simple messages for those people that are perhaps coming closer towards retirement age is that you can take 1.5 times your salary tax-free from your pension fund if you're going to end up with 20 years service in that company. So I've had situations with clients whereby they may have had no money in their pension fund. They might be a year before they retire on a salary. In this example I've thrown on the screen here is 66,000 a year. They could literally write a check to their pension for 100,000 euros that they could set up within a day. We can assist them with that. And they can draw the 100,000 back out the following day, tax-free. It's an absolute no-brainer. If they happen to have 50 grand already in their pension fund, they just write the top up for a further 50. And these are angles that people are sometimes not familiar with, that again, go a long way towards making this roadmap as I've described. And it really is important that people do have a financial roadmap that they can position themselves in the most appropriate manner. The last thing I want to say on this is that not all pension funds are the same. I've thrown up a chart here of just a comparison of two funds, both of which are medium risk. And I talk to clients about risk and reward quite a lot. The scale runs from 1 to 7. These are two funds that are in the middle of that. By virtue of their names, you can see the 4 at the end of them. Zurich versus Irish Life. And over the last 5 years' performance, Zurich's funds have vastly outperformed, almost doubled the return on an annualized basis, which is significant. And I say to people all the time, Alpha Wealth are an independent brokerage. We're not in any way tied to any particular insurance company. But in our view, we feel very strongly you need to be with the best manager and you need to pay the lowest fees possible. And for those people that have previous pension schemes, you should look to make sure that they're properly managed. For those of you that are in current pension scheme arrangements, make sure that your funds are appropriately invested. And please feel free to reach out to us. We will happily advise you on what the best funds are. Now, in terms of the takeaways, and I said to you that you'll get something from today's webinar, building money up in your business to take it out tax effectively. I've given you an indication of pensions. I've given an example of getting money back from the taxman. Business owners that sell their company, there's a relief called entrepreneurial relief, which allows you to sell a business or to release your shares in a company of up to €1 million, and you pay a lower rate of capital gains tax of 10%. Some business owners are not familiar with this. You should be, in my view. I'm very familiar as a business owner of this type of relief that's available. There's another form of relief called retirement relief. Now, you can only avail of one or the other, and don't get bogged down by the phraseology. Just to understand that as a business owner, if you sell your business or your share of your business, you can get out €1 million at a low rate of tax. If you're leaving a company, so if you're retiring the company, you can take up to €750,000 tax-free from that company, as long as you've been a shareholding employee, having drawn a salary for the previous 10 years. So as I mentioned earlier, I'm 47. One of the reliefs I'm looking to achieve is retirement relief, where when I reach 55 years of age or beyond that, I know that I can take out 750,000 tax-free from my company. If you're in a situation, and again, the example's thrown up here, where Paula sells her share, she can sell up to 750. But if Paula and Joe run the business together as a couple, they can take up to 1.5 million out of their company tax-free. And the key thing to note is that you need to do a little bit of planning. And there are a few criteria that you need to meet, and ignorance is not bliss here. So anyone who is in their kind of early to mid 40s, or indeed if you're in your 50s, you should be aware that these reliefs exist, and you should be talking to your accountant or a financial advisor such as Alpha Wealth as to ensuring that you understand what these reliefs are and that you take advantage of the opportunity as it presents itself. Now, just to move on, I just want to talk briefly around protection arrangements. I'm not going to dwell too much on this. The one thing I'd say to any business owner out there or any key employees of a company, it is really important to understand who the shareholders are and that the shareholders are protected. And there is a simple plan that I always talk to company owners about called shareholder protection, where, for example, let's say John and Jim own a company, they're 50% shareholders of, it doesn't have to be equal split, and let's say the company is worth 2 million. It is fundamental, in my opinion, that they ensure themselves that in the premature demise, i.e. the passing of one of those shareholders, that they have cover to pay out the estate of the deceased shareholder. Why is that important? Well, what they don't want is that if John passes, Jim has to try and find €1 million to get John's estate off his back. And it's caused terrible problems for businesses. And in my view, I think it's really important that companies get a cost and understand. And you don't have to always necessarily fully mitigate this. You can partially go some way towards mitigating this issue. And it's a really simple thing. The company pays for it, gets tax relief on it, and it's a tax-free benefit to the next of kin. Further to that, I speak to any businesses where there's 3 or more employees. And as any senior managers that are listening to this call, I think it's really important to note that your business can have death in service at a very low cost, where it insures employees. And you can categorize this for senior employees, for employees that are permanent. The criteria is completely variable. And again, the example I'm using here is that you have 3 people working for a company, average salary of say 50,000 a year. They can be insured for 4 times their salary Company pays a premium. The premium is significantly reduced. There is no medical underwriting. So I've had clients who wouldn't be able to get life cover because of, say, some medical history, and they can get this cover without any medical underwriting whatsoever at a really low cost. It is a no-brainer for any business and for any individuals out there that have 3 or more employees. I think it's really worthwhile, at the very least, getting an understanding of the costs involved. We act as a broker, we shop out for this business, and it's a really simple process. The last area that I'd like to talk about is income protection. It fascinates me that a lot of people who are earning incomes of 50, 60,000 a year or more have no form of income protection. And yet many of these people are insuring their phones and other, things that they insure for. And the one thing I want to say is that for most of us, our income is going to always be our biggest asset. The example again on the screen here is that anyone who's earning, say, 50,000 a year, is working for the next 20 years, that's €1 million. And a lot of us will earn a hell of a lot more than that over the next 20 years. So it's really important to understand that there is a product that my industry provides where you can insure yourself if you're sick, you have an accident, disability, or illness. The company gets tax relief, or you as an individual can get tax relief. And again, it can be done on a group basis if there are more than 3 employees. Now, people often ask me, Nick, what would have to happen for me to get a claim? Well, you need a doctor's cert that basically says you cannot work, or you cannot work to the extent that you were working previously. Okay. The biggest form of payment is psychological illness now, which only has happened in recent times. Orthopedic issues were the highest, followed by cancer. And obviously it's becoming a little bit more, I suppose, relevant in the times that we live. As I said earlier, we make the process really simple. We just require confidentially just information on the members to be insured, and we go away to the 11 providers in the marketplace and get the cheapest costings. There is no obligation to go with these, but what I say to people is it's worthwhile knowing what you can do as an employer, and importantly, what you are covered for as an employee. The final area I'd like to touch on is company savings. Now, this equally kind of, I suppose, equates to personal savings, but I'm coming across more and more companies that have money sitting on a deposit or a current account. And as I'm sure you're all aware, there is no interest to be earned from the banks, credit union, post office. And for corporate savings, those interest rates are starting to be and will become more so negative. And the banks are starting to charge somewhere in the order of 0.5 to 0.65% of an interest rate to clients to actually hold their money, which sounds perverse, but that's the world that we live in. Now, it may not seem like a large rate, but again, I've thrown up on the screen there for a company that say is sitting on 500,000, the loss of that amount to a company over a 5-year term is about 12,000. If that rate increases, which it very easily could, that obviously doubles then to about 24,000. And the one thing to note is that there's a really simple solution. I mentioned earlier about putting money into a pension. There is another alternative. I've given an example there of a Zurich account that I really like. It's a way of you putting money into an investment or saving monthly or doing both, where you have total access to the money. It's very flexible. It's diversified. Again, I'd encourage you to consider what fees you're paying. And if you've set these up elsewhere, just check in with the provider of the costs, because there are sometimes hidden costs. And I would suggest that we would be a very low cost provider out there. And again, I'm happy to be challenged in terms of fees. But the key thing to know is that these accounts will make money. I'm absolutely certain of that. And they're better a deposit account. I have no doubt of that whatsoever. And again, just to throw up an example of the types of performance, even in the times that we've faced in COVID and Brexit and the Trumps and so on and so forth, on average, these accounts have given returns of somewhere in the order of 5 to 10% per annum. So you can get quite a significant return on your savings. So I just want to finish off just to say thank you for your time. As I said, if anyone does want to stay on the call afterwards just to ask any questions, I'm happy to take them. If you'd like to email me afterwards, or indeed my colleague David Looney, there is a chat box if anyone does want to type in any questions. We will respond to all of the messages. And indeed, as I say, we're happy to share the video with you and the presentation afterwards. The areas that I'm happy to talk to clients about are health insurance. We don't sell health insurance. We don't charge for this service. But if anyone out there gets a health insurance renewal or wants me to give any guidance, I've never met a client that I haven't been able to help in health insurance. And I mean that sincerely. Mortgages, I do not sell mortgages, but I definitely help people get lower rates on their mortgage without too much drama. In most cases, it's going back to your bank. And again, I'm happy to provide some guidance to people. I would ask you to ask yourself, do you know what rate of interest you're paying on your mortgage? If you don't, I think that you should know. I think it's a given really in this environment. And because of the fact that mortgage rates are going down, in some instances, it actually pays people to break their mortgage terms. For those of you that are fortunate enough to have a tracker rate mortgage, they're obviously the ones that people hold on to with dear life. Again, there may be some advice needed, specifically if you're looking to move property, for example. I've not talked about estate and succession planning in great detail. I did mention, obviously, the two forms of relief for business owners. There is a little bit more that I could say, and it might be something just as simple as setting up a child savings or a grandchild savings account, how to do it tax effectively, or is there a better way of you putting money to work and using the money that you have? Claiming certain tax reliefs. I haven't spoken about them today, but there are definitely reliefs that are available to people. For those of you that have been working from home, for example, you should have claimed back relief for last year. And if you haven't already done so, please feel free to reach out to me. My email address, which is listed here, which most of you have, nick@alphawealth.ie, or feel free to give me a call on my mobile. I'm happy to go through that with you. Just to finish off, guys, because I'm conscious of time, and thank you for your time today. On the poll,